Hello everyone, Brian Graham here. I'm the manager of Treasury at First Calgary Financial, and this is your monthly economic update. Expect the current low-rate environment in Canada to persist for at least another couple of years. That's the message according to the Bank of Canada's Stephen Poloz, as he announced on Wednesday that the bank's key rate will be staying put at 1%, a level it has idled at now since September 2010. The bank did manage to provide some forward guidance to financial markets by stating that the timing and the direction of the next change in the policy rate would depend on how new information influences the balance of risks. Most eyes were on the tone of the statement released by the central bank on Wednesday, which is usually scrutinized for any indications of future concerns or rate movements, and analysts were not disappointed. While most were expecting the bank to take a slightly more dovish tone in its statement to avoid any rebound in the Canadian dollar, the outlook on inflation was front and center as it was elevated to the first paragraph of the statement, a place usually reserved for the global growth outlook. The bank also went as far as to highlight that the downside risks to inflation have grown in importance in the final risks paragraph on the statement. But perhaps one of the key indicators of the bank's mood was a statement that was actually buried within a box in the monetary policy report and read that despite depreciating in recent months, the Canadian dollar remains strong and will continue to pose competitiveness challenges for Canada's non-commodity exports. This helped push the loonie to an almost 4-year low just a day later and left no question that Governor Poloz will be a good friend of the Canadian exporter. The bank also upped its estimate of GDP growth for 2013 and 2014 to 2.5% for both years, while noting that there has been few signs of the economy rebalancing towards exports and business development. Clearly, the bank is counting on accelerating growth in the U.S. to spur the demand for more Canadian exports and pull both countries out of their current low-growth malaise. So what should we take away from the Bank of Canada's last pronouncement? Number one is that rates are going to stay a lot lower for a lot longer than anyone ever thought, because it is taking a long time for economic imbalances highlighted by the credit crisis to unwind. Second, our central bank is not worried about the decline in the loonie one little bit, and even at 90 cents US still considers it overvalued. And finally, household debt accumulation in the housing market, while still on the bank's radar, may not be as big a concern as previously feared. Until next time, thanks for watching.